pop open the champagne and drink a toast to 2016, a year full of surprises. 2016 started with a surprise, the worst start to a year in Wall Street history. Fears of a global slowdown and a crash in crude oil prices triggered an 11% stock sell-off in the first 6 weeks of the year. The first quarter was a wild ride, but after the positive economic data kept coming, stocks rebounded and eked out a 1.4% return. In the second quarter, stocks returned 2.5%, but those average size gains were fraught with fear. On Friday, June 24th, Great Britain's vote to exit the European Union caused a two-day 5.3% plunge in stocks. Then, almost as quickly, investors realized they had overreacted. Surprise, Brexit was not an economic event. Stocks recovered by the end of June. In the third quarter, stock returns surged 3.9% after the positive economic data continued to stream in. But in the fourth quarter, stocks popped, pouring forth a 4.3% total return to cap off the year. Both the Standard & Poor's 500 Index and U.S. Gross Domestic Product, the metrics of U.S. financial and economic strength, surprised everyone pleasantly in 2016. Stocks defied expectations, gaining 12.5% in 2016. That's 30% more than the average annual return on stocks since 1926 of 9.5%. And after the November 8th election of Donald Trump as the 45th U.S. president, which was a huge surprise, stocks repeatedly broke records before profit-taking in the last week of the year. What's more, the economy in 2016 grew by 3.5%. That was better than almost anyone expected at the start of the year. This chart of recessions and recoveries since 1957 versus the price of stocks shows that the current expansion, at 91 months old, is a little more than 2 years shy of becoming the longest recovery in modern U.S. history. If nothing bad happens, this expansion stands a fair chance of becoming the longest on record. The depth of destruction wrought by the Great Recession has made this expansion different from others. Slower, but with inflation staying dormant. The 2.4% growth rate expected in 2017 maintains the economy's growth trajectory in a stable, sustainable, low-inflation environment. This 60-year chart of U.S. economic cycles shows that recessions trigger bear markets. However, not every bear market has occurred in times of recession. Stock price corrections of 10% or even bear market drops of 20% or more have occurred during economic expansions, and that could happen again. At this stage, in an extended bull market, broadly diversifying becomes difficult for some investors. When they see stock prices soaring, they lament not owning more stocks. So, let's talk about that. By definition, diversified portfolios can't keep up with the returns on the S&P 500 in a bull market. A diversified portfolio is guaranteed to always underperform the best-performing asset class in a portfolio. Diversifying is a systematic way of trying to moderate the ups and downs of investing for the long run. If you're on a path with steep ups and downs, you are less likely to get where you're trying to go. A frightful descent is more likely to make you abandon course. If you own an all-stock portfolio, you'll bail out of the market when things get scary. The moderate path is not as exciting, but easier to complete. So remember that you cannot compare the S&P 500 return to a diversified portfolio built for achieving long-term financial planning goals. And precisely because of the kind of surprises seen in 2016, staying committed to a strategic investment plan based on diversification remains the best way to win the race in the long run. The surprise 16.8% return on high-yield bonds in 2016 underscores the wisdom of diversification and rebalancing. For high-yield bonds to be the number 2 performer among 13 different asset classes defies logic. High-yield bonds are a fixed-income asset class, and fixed-income investments were among the worst performers for the year. Yet, junk bonds in 2016 returned nearly 100% more than their average annual return over the past 5 years of 8.5%. The return on junk bonds was completely unpredictable, a total surprise. So don't lament not owning more stocks, because no one can reliably predict the next best asset class. Another important takeaway from the one-year performance of asset classes is that master limited partnerships were the #1 asset class of 2016, after getting hammered in 2015. Looking at 5 years of returns, the Standard & Poor's 500 was #1 among the broad sampling of 13 asset classes, hinting at what a heady period this has been for U.S. stocks. Bonds showed a 9.3% cumulative return over the past 5 years, a tenth of what stocks returned in this same period. And it's almost certain that the next 5 years will be even more cruel to bond investors. Interest rates over this past 5 years hit lows not seen in generations in a long cycle of declining interest rates. However, the Federal Reserve hiked rates a quarter point in December 2015 and again in December 2016. And while rates are widely expected to head gradually higher in 2017, a rising rate cycle is now underway and will likely last for years. As 2017 begins, the bull market is old by historical standards, and a drop in stock prices could occur at any time. But key economic benchmarks are showing none of the signs that normally precede a recession, and stocks could head higher still. No one knows, and you just have to expect more surprises. These weekly reports are a trusted source of financial news based on economic fundamentals and authoritative sources, free from the influence of big media, Wall Street, and politics. A prudent analysis of news affecting your wealth over the long run. Please feel free to share our timely weekly reports with your family and friends. Although 2016 will be remembered as a year of good financial surprises, we hope the year ahead will be even better for you, and we wish you and your family a healthy, happy, and prosperous 2017.